Stop scrolling. I need you to imagine something for a second. You're handed a check, $5,000, $10,000, maybe even $20,000. You deposit it, and here's the kicker. You pay $0 in income tax on it. Not a fraction, not a percentage, zero. Sounds like some offshore tax haven scheme, right? Some Panama Papers loophole? Nope, this is 100% legal. It's hiding right inside the US tax code, and most Americans have absolutely no idea it exists. Most people look at their home and see a mortgage payment, a monthly burden, a place to crash after work. But what if I told you that same home could be the single smartest financial asset you ever own? Not just because it appreciates, but because it can generate income the IRS literally cannot touch. Today, I'm breaking down what's known as the Master's Rule, a provision so powerful that the ultra-wealthy use it every single year to generate completely tax-free income from their primary residence. And by the end of this video, you're going to know exactly how to use it. Plus, what happens when you scale it up and go beyond the 15-day limit. I'm the Wealth Guardian, and this channel exists for one reason: to protect your wealth through education. We take the complex legal stuff that CPAs and tax attorneys use to shield millions, and we break it down into plain English so you can actually use it. If you're serious about keeping more of what you've earned, do me a favor right now. Hit that like button, subscribe, and ring the bell. I'm going to ask you again at the end, but I need you to stay until the very last second. Because after I explain the loophole, I'm going to show you what happens when you cross the 15-day threshold. And honestly, it gets even better. You can still win massive tax deductions. Standard disclaimer, everything here is strictly educational. This is not legal or financial advice tailored to your situation. Always consult a qualified professional before making moves. Now let's get into it. To understand this loophole, we need to take a trip to Augusta, Georgia. Every April, this small city hosts the Masters Golf Tournament, one of the most prestigious events in all of sports. For 1 week, hundreds of thousands of wealthy fans, Fortune 500 executives, and celebrities flood into a town of about 200,000 people. Hotels sell out a year in advance. Restaurant reservations? Forget about it. So what do the locals do? They rent out their homes. And I'm not talking about listing a spare room on Airbnb for $80 a night. I'm talking about entire homes, 3, 4, 5 bedroom houses going for $500, $800, even $1,500 per night during Masters Week. Some homeowners pull in $15,000, $20,000 in just 5 to 7 days. Now, here's where it gets interesting. Normally, if you earn $20,000 in rental income, the IRS wants a piece. You'd report it on Schedule E, pay taxes on the profit after deductions. But these Augusta homeowners discovered something the rest of us missed. Under Internal Revenue Code Section 280AG, and yes, tax professionals actually call this the Master's Rule because of Augusta. If you rent out your entire home for 14 days or fewer in a tax year, the rental income is completely tax-free. You don't report it, you don't pay tax on it. It's as if the income never existed as far as the IRS is concerned. Let me say that again. 14 days or fewer, entire home. The money you collect, whether it's $3,000 or $30,000, is yours. Tax-free. No reporting required. The IRS literally does not care. And here's what makes this so powerful. We're all conditioned to believe every dollar we earn gets taxed. Your salary? Taxed before you even see it. Your side hustle? Taxed. Your investment gains? Taxed. But this is a completely different faucet. This is income that flows straight into your bank account, and the tax system doesn't even acknowledge it exists. The IRS isn't hiding this from you. It's right there in the tax code, plain as day. They just aren't going to knock on your door to teach it to you. That part's on you. Now, you don't have to live in Augusta, Georgia to use this. That's the beautiful part. Think about where you live. Is there a major event that brings thousands of visitors to your city? The Super Bowl rotates. If you're in the host city, that's gold. The NCAA Final Four, the College World Series. Major conventions. CES in Vegas, Comic-Con in San Diego, SXSW in Austin, music festivals, Coachella, Lollapalooza, Bonnaroo, film festivals, Sundance, TIFF. Any of these events can turn your home into a tax-free income machine. And with Airbnb and VRBO, it's never been easier. You list your property, block off 2 weeks on the calendar, take your family on vacation, and let the renters literally pay for your trip, and then some. Because every dollar is tax-free, the entire amount goes straight to your bottom line. Let me give you a real example. Say you live in Indianapolis when the Super Bowl comes to town. You list your 3-bedroom home for $400 a night. You block it for 10 days, that's $4,000 in gross rental income. Because it's under 15 days, you report nothing. You pay zero tax. You take your family to Disney World for $3,500, and you still come out $500 ahead, completely tax-free. Or say you live near Coachella in Indio, California. You rent your home for 14 days at $600 a night. That's $8,400, tax-free. You use $6,000 to take the kids to Hawaii, and you've got $2,400 in pure untaxed profit sitting in your account. This isn't theoretical. People do this every single year. And the best part? You don't need an LLC. You don't need an offshore account. You don't need a tax attorney on retainer. You just need to know the rule exists and time it right. This is what I mean by hiding your wealth in plain sight. The strategy isn't secret, it's just unknown. And that gap between what's legal and what people actually know, that's where real wealth is built. All right, let me pause here and ask you something directly. Have you ever rented out your home, even for a single weekend? Or have you thought about putting your place on Airbnb during a big local event? Did you know this 14-day rule existed before today? Be honest, drop a comment right now. Tell me your city and the biggest event that comes to town. I read every single comment, and your answer might spark an idea for someone else in this community. Let's make this a real conversation. Now, here's where it gets even more interesting, and, honestly, even more powerful. What if you love the income so much that you want to rent out your home for more than 14 days? Maybe you want to do it every month. Maybe you want to turn it into a real rental operation. The moment you cross 15 days, the master's rule disappears. The income becomes taxable. You have to report it on Schedule E. But before you panic, hear me out. Because crossing that line doesn't just unlock a different game, it unlocks a much bigger game. When you rent for more than 14 days, you're no longer in the tax-free bucket. You're in the rental business bucket. And the IRS gives rental property owners some of the most powerful tax deductions in the entire code. Let me walk you through the big ones. First, operating expenses. Every dollar you spend to keep the property rentable is deductible. Mortgage interest, deductible. Property taxes, deductible. Insurance, deductible. Repairs, maintenance, utilities, lawn care, cleaning supplies, HOA fees, all deductible. If you spend $15,000 a year on these costs and collect $20,000 in rent, you're only paying tax on $5,000. But the real game changer is depreciation. This is where the wealthy separate themselves from everyone else. The IRS allows you to deduct a portion of your home's value every single year, 27.5 years for residential property as a non-cash expense. So if your home is worth $300,000, you can deduct roughly $10,900 per year. And here's the kicker. You don't actually spend this money. It's a paper deduction, but it reduces your taxable income dollar for dollar. Let me show you how this works in practice. Say you rent out a basement apartment for $1,500 a month. That's $18,000 a year. Mortgage interest on the rental portion is $6,000. Property taxes allocated to the rental, $2,000. Maintenance and repairs, $3,000. Depreciation, $10,900. Total deductions, $21,900. Your taxable rental income? Negative $3,900. You owe zero tax. You might even have a passive loss that carries forward to future years. You're collecting $18,000 in cash every year, paying zero tax on it, and the IRS is the one who gave you the tool to do it. That's not a loophole. That's the tax code working exactly as written. And there's one more layer. If your total taxable income is under $182,100 for married filing jointly in 2024, you qualify for the 20% qualified business income deduction under Section 190A. That means even if you do have some taxable rental profit, you can knock off another 20%. So on $5,000 of taxable rental income, you'd only pay tax on $4,000. The mindset shift here is massive. Most people see their home as a cost center, a mortgage, taxes, insurance, maintenance, money going out every month. But the wealthy see their home as an income-generating asset with built-in tax shields. The same property that costs you $2,500 a month might be bringing in $3,000 a month in rent, with most of it tax-free or tax-deferred. You don't need a commercial building. You don't need 50 units. You need one home, one strategy, and the willingness to think differently about what a house actually is. But let me save you from the two biggest mistakes I see people make. Mistake number one, they try the 14-day rule but accidentally cross the line. You have to be precise. If you rent for 15 days, even by one single day, the entire year's rental income becomes taxable. Not just the income from day 15 onward, the whole thing. So track your days carefully. Mistake number two, they think they have to move out for all 14 days. You don't. The rule applies even if you're living in the home for part of those 14 days. You could rent it for 10 days, live in it for 4, and still qualify. Personal use during the rental window doesn't disqualify you under the 14-day rule. And here's the mindset piece I want to leave you with. The tax system doesn't reward the hardest worker. It rewards the most informed. These rules weren't written to punish homeowners, they were written to encourage homeownership, housing development, and economic stability. The government literally wants you to own property, so they built in these protections. Your job isn't to fight the system, your job is to use it better than the person next door. So here's your action plan. Want simple, tax-free income? Find the biggest event in your city. Block off 14 days or fewer, list your home, and let the money roll in. Tax-free. Want to go bigger? Rent long-term. Use depreciation and operating expenses to shield your cash flow and stack the QBI deduction on top. Either way, your home stops being just a place you live. It becomes a wealth-building machine with tax protection baked right in. Now I want to hear from you. What's the biggest event in your city? Are you going to try the 14-day rule this year? Drop it in the comments. I read every one. If this video helped you, hit that like button, subscribe, and ring the bell. We drop wealth protection blueprints like this every single week. Building wealth is hard. Keeping it is harder. But knowing the rules, that's how you win. Stay prepared. Stay protected. I'll see you in the next one.